Hello and welcome to another MCO market update on FET. The Fetch AI chart is, in my opinion, still in or under selling pressure. We have not yet seen any upside breakout attempt, and we have a three-wave decline currently from the 12th of May high. So just to double check here, or to confirm actually, we do have something that looks like a five-wave advance, a five-wave rally into the 12th of May high from the 7th of April low. So that actually is a possible five-wave move up. And this five-wave move up sets the stage for further upside, but only as long as the pullback really remains corrective in nature and remains a WXY structure or ABC. I've labeled it WXY structure now because of the proportions. If we basically get another C wave down within wave Y, we would land directly in this target area between 16.8 cents and 14.7 cents. So just saying this is an ideal target zone. Again, it's WXY structure and the Y wave would be ABC. So that's what we're tracking. As long as we're holding below the last swing high at 21 cents or 20.9 cents, the immediate pressure is downward. We can also add some kind of Fibonacci resistance here, which is currently defined between 19.1 cents and 20.3 cents. This would be the nearest resistance area to watch. Now we're here already operating on a very small time frame. So when you watch the video, maybe things have already changed. But at the moment, I don't see any change here in structure or in the scenarios. The pressure is just downward as long as we stay below the 20.3 cent level. Above that level, it's that last swing high at 21 cents that would need to be broken to, let's say, unlock directly higher prices. For now, the pullback is a three-wave move, but we have not yet reached the ideal target zone between 16.8 cents and 14.7 cents, which is, again, an ideal target for a Y wave. This is measured based on the initial decline from the 12th of May high, the wave W essentially, and by comparing it with the Y wave. So waves W and Y, they often have the same length or they are a little longer. So it's this area typically between the 100% Fibonacci extension and the 161.8 Fibonacci extension. And yeah, this zone is relevant. I would expect it to be tested, at least as long as we're holding below that 21 cent level. Yeah, but the overall five-wave advance allows us to overall watch for higher prices. Yeah, I still like the idea of upside trend continuation. It's just critical that in this potential 1-2 setup that we are tracking here in the blue scenario, which is generally a bullish standard setup from an Elliott wave point of view, it is critical that we don't break below the 14.2 cent level. So 14.2 cents, that's the 78.6 Fibonacci retracement. And any break below that is actually too deep for a wave 2. So it would be a little bit too much of a pullback for wave 2. In that case, then we can watch for a wider wave 4. But at the moment, the blue scenario suggests the wave 4 could have bottomed here on the 7th of April. Again, you know, that's the current thesis. As long as we're holding that level, and specifically the 14.2 cent level, focus is on higher prices. 14.2 cents, that's the level where probabilities shift. Any break below that will likely lead to invalidation, which would be a break below the April low, and then we would reset this wave 4. Okay, but for now, yes, we are in a correction, but the idea is that this is going to form a higher low. But we have to see how the market reacts to that support area shown on the chart. So that means we have in the short term still a little bit more room to the downside. Yeah, that's the update on HBAR. I hope you liked the update. If you did, please hit the like button, leave a comment and subscribe. And if you really like the content, then please check out the channel membership. Thank you very much. Bye-bye.